Okay, thank you everyone for taking your time out of your busy schedules to join us for today's session on tax implications of borrowing money from your corporation. We've got lots of interest in this webinar, lots of people registered, so excited to chat with you guys about this topic, which I know can be confusing for a lot of people. So we'll start with a little bit of housekeeping here. First, I'll get my mic a little bit closer so you can hear me better. Anyone who is live with us here in Zoom can ask questions using the Q&A feature. I'll be looking at that throughout the webinar, so if you have any questions, I'll do my best to answer them as we see them. If we get to the end of the session and there's no further Q&As, I'll take a last look through the chat to make sure that nothing has been missed, but I'll be looking at the Q&A first and foremost. If you happen to be joining us on one of our social media channels, whether that's YouTube, Twitter, Facebook, or LinkedIn, you can post your questions as a comment on the feed, and one of my colleagues will do their best to relay that over to us so we can answer it live. And if we happen to miss it, we'll make sure to come back and answer that question after the session. So without further ado, let's kick off onto our session and talk to you about the tax implications of borrowing money from your corporation. So for those of you who aren't familiar with myself and our organization, my name is Andrew Wall. I'm the managing partner here at CPA4IT. We're an accounting firm specializing in service-based businesses, and our mission is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We've won a number of awards across the industry, as well as have worked closely with the National Association of Computer Consulting Businesses, which is a lobby organization of all the major staffing agencies, where we've worked on all sorts of major issues from personal service business to WSIB, and all those issues facing independent contractors and service-based businesses. We are an ISO 9001 registered accounting firm, which basically just means we have systems and processes, and those are externally monitored to make sure that we're constantly striving for improvement and that we're rigorously following the processes that we have outlined. But let's get to today's topic and a little bit about our agenda. So first, we're going to start with a little bit of understanding of the shareholder accounts. And I know that they can often be very confusing, so we'll spend a bit of time there. Talk about the repayment rules, the taxable benefit, some exceptions that exist, and then the documentation and interest rates that have to be used when you are doing a formal loan from your business. So let's talk first about the shareholder loan account, or sometimes referred to as the director's advance account. Now, for many of our clients, they are taking money out of their business throughout the year through the through what we call the director's advance. So again, maybe we'll start with a clarification between director's advance and shareholder loan. These are sometimes used interchangeably because if it's a liability, meaning that you have lent money to the corporation and it owes it back to you, that is a shareholder loan. Whereas if it's an asset, meaning you have taken money out of your corporation, we call that a director's advance, an advance to the directors. But it's actually the same account, gets renamed slightly depending on whether it's in an asset or a liability position. Now, as I said, what's unique to our client base is that we're dealing with service-based businesses, typically owner-managed businesses, who are not drawing a monthly salary from their corporation. They are taking out money from their corporation as they need it on behalf of the corporation so that they can pay for expenses on behalf of that business. And this is done through the director's advance account. And this is often very, very, very confusing for clients who have never dealt with this type of account. And the easiest way that I can explain it is as an imaginary bank account. And so every time that you draw money out or you take money out of your corporation that is not for a business expense or something like a salary, then that is going to increase the balance in this imaginary bank account. Now, on the flip side of that, if you use personal credit cards, personal bank accounts, cash, or anything other than the corporate bank account or corporate credit card to pay for expenses, it will reduce the balance in that imaginary bank account. And this imaginary bank account sits on the balance sheet of your financial statements. And there are very specific rules around the shareholder loan account or the director's advance account around whether this can be considered a long-term loan or whether it is a single purpose loan or whether it's going to be repaid at the close of the year, which is what most of our clients will do by declaring a salary that offsets that loan or a dividend that offsets that loan. So the rules basically tell us that the director's advance can be in a debit position, i.e. you have borrowed money from the corporation for 1 year with no explicit purpose, as what we sometimes refer to as a single purpose loan. So you can give yourself effectively a loan for 1 year, but in that subsequent year, the director's advance balance must be cleared back down to a credit position or at least a zero balance, which effectively means you can take a loan for no explicit reasons for 1 year, but in that subsequent year, you must repay that loan and you're not allowed to take a loan in that subsequent year as a single purpose loan. Now it's important that I differentiate between a single purpose loan and an automobile loan or a car loan, which we will talk about in a second. And there are conditions for borrowing from the corporation, like these have to be monies that will be used for business operations and expenses, which is why we say you're taking out money so that you can pay for expenses on behalf of the corporation. And there are some legal and tax implications, and we're going to go through all of those as we go through the various different types of forms that you can have associated. Now, as I mentioned earlier, there are some repayment rules. And so for the single purpose loan, they must be repaid within 1 year. And the payment methods can be a direct repayment, i.e. you're putting the money actually back into the corporation, or as we said earlier, the more common situation, which is setting of a dividend or a salary to offset the balance in the director's advances. Now, if it isn't repaid, there will effectively be a deemed repayment and it will be considered income and taxed accordingly, which can have some serious implications that you aren't intending if you're not doing proper tax planning. Now, I recommend that every one of our clients make sure that they're keeping up to date with their finances and make sure that they're doing adequate tax planning with their account manager here at our organization. Now, I do want to talk about a couple of different other types of loans that you can have other than a single purpose loan. So the single purpose loan, which must be repaid within 1 year and you're not allowed to take another loan, is, like I said, for any explicit reason or non-explicit reason. It can be for anything that you want. It does need to be documented, and we'll talk about that later. But you can also take out the loan for a purchase of a car or a purchase of a home. Now, these loans are slightly different than the director's loans that we talked about earlier. These loans are actually employee loans. And with these come some taxable benefits, which we'll talk about in a second. So there are very specific rules in order to be able to take an auto loan or a home loan. And there are very specific rules around the repayment deadlines and repayment methods and the interest rates that are used to calculate the actual interest on these loans. So the rule, and we have up here, must be repaid within 10 years, which is typically what most of our clients do. But the guidelines tell us that it must be consistent with any other loans that you would find in the market. And so the longest that we'll do a loan for is 10 years. That's the maximum that you can do as a repayment period on a auto loan. So if you take out money from your corporation for the purpose of purchasing a vehicle, and this vehicle would then be owned under your personal name, not under the corporation's name, we can set up this loan. And the advantage of doing this is that you don't actually have to take all the money you took out of your corporation into income. So if we weren't setting it up an auto loan, this would follow those rules of the single purpose, and it would have to be repaid by the next year or taken into income. So you can imagine if you're paying, $30,000, $50,000 for the purchase of a vehicle, if you had to take that into income all in 1 year on top of what you normally draw, this can put you into a higher tax bracket and have some negative tax consequences. Whereas if we go with the loan, effectively what this is allowing us to do is to take 1/10 of that purchase, or $5,000 each year for the next 5 years. And the only downside of doing this is that we do have to calculate interest. We do have to do some documentation, and that interest will show up as a taxable benefit. Now, the principal, yes, has to be repaid. How is that repaid? Again, typically by taking some additional salary in those 10 remaining years. So instead of having an additional $50,000 on top of your normal salary in 1 year, you'll have $5,000 on top of your normal salary for 10 years. And because of the way that the marginal tax system works, whereas your income goes up, you'll pay a higher tax in the new tax brackets as they go higher and higher and higher. So if we can smooth this and keep you from going into higher tax brackets, you'll pay less tax overall. And as I said, there is a cost because we do have to calculate interest on this, but you're paying yourself the interest. So the cost of taking this loan is not actually the interest, but rather the tax on the interest. So you're talking whatever your personal marginal tax rate is times the interest. So you're talking a percentage on a percentage. And it does look like we do have our first question asking if we'll get the slides. We can make the slides available. Just reach out to my colleague, Rachel, and she'll be happy to share those with you. We don't normally send a follow-up message, but the entire session will also be available on all our YouTube or on all our social media channels. But if you reach out to my colleague with your email address, I'm sure we'd be happy to provide these. So keep those questions coming. Happy to answer them as we go through the session. So there's some significant advantages of being able to set up the loan for purchasing a vehicle. So this typically needs to be done when purchasing the vehicle or when purchasing the home. It can also actually even be done, sorry, did I go the wrong way? It can also be done for the purchase of a boat as well. Now, there are some stipulations. If you are doing it for a boat, it usually has to have a head in the boat in order to qualify. But then we can do loans for the purpose of purchasing a boat as well. And again, like I said, these are employee loans, not director loans. Oh, geez, this thing is responding slowly to my taps. And so I'm getting off pace here. And it looks like we do have another question. Are we able to do this for an investment property as well, i.e. a vacation home? No, typically not. If it's a secondary residence, yes, you can, but it has to be a residence where an employee is residing. You can have multiple properties, but it's not for an investment property. If you're doing an investment property, you might look at just structuring that as a corporate investment as a potentially better solution. Now, getting into the rules for a home loan, again, same rules here, that it has to be consistent with what you'd find in the market. So typically what we're seeing is a 25-year repayment period. And again, repayment methods are the same. You can put the money back in, or what most of our clients do a salary to take a percentage of, or to take that 1/25th of that loan into income each year for the 25 years. And again, if you don't repay it, there will be some negative repayment consequences, and it will be considered income and taxed accordingly. So there's no real getting out of it. Now, one of the other questions that we do get asked is, with either of these loans, could I repay them faster than the terms provided? Yes, you can. So if you set it up initially for 25 years, you get a windfall, win the lottery, who knows, and you want to put the money back into your corporation and repay the loan, you can do that at any time that you like. There are also some specific rules around the interest rates that we use. These are prescribed by CRA, so they're not open to interpretation, and they do get revised with a home loan every 5 years. Can the loan be for renovation costs on your current home? So we used to say no to this, but because we used to be really big sticklers that it can only be done in the year in which you purchase your home. There are some rules that allow you to do a home loan in later periods after the purchase of the home. So there are some unique circumstances when we can do a loan for the renovation of your current home. Again, I would recommend in that situation that you speak directly with your account manager about your individual situation and do some specific planning. But it technically is not available for the renovation itself, but there are usually some tricks up our sleeve and some ways for us to do a home loan later on, timing with a renovation that is tied back to the purchase of the home, not to the renovation. But it's not, the renovation itself is not eligible for a home loan. But there are ways to structure it so that we can get the timing so that you have funds available for the renovation that is still a home loan. Again, speak with your individual account manager and we'll go through the specifics of that with you. So let's talk about the taxable benefits, which is really the only downside that we have with setting up and structuring these loans. The loans, as we said earlier, they'll become fully taxable if they're not repaid within the specified time limit, or if you don't have the valid supporting documentation that's necessary. Again, for our clients, we will do this as part of the annual minutes. We will do that appropriate documentation for you. We're going to obviously collect the key pieces of information that we need from you, like the home purchase amount and all those details. The taxable benefit itself will be taxable as part of your T4. So it shows up as a benefit on your T4 and will be subject to your personal tax rates. We got another question here. Can the home loan amount be purchased after the purchase date? Increased after the purchase date? Yes, it can. Like I said, so there are some exceptions where you can take additional loans later on. There are still some limiting factors on the home loan. You can never, and this is an important thing to note for both the home and the auto loans, is one, you can't loan more than the value of the vehicle. And from that, you have to subtract any other loans that you have. So imagine that you have a traditional mortgage. Let's say that you buy a property for $500,000 and you got a traditional mortgage of $250,000. That means the maximum available home loan amount would be $250,000. Now, this is also subject to the corporation having the funds available to lend, which is another stipulation. But assuming that you've got the funds available, you could lend $250,000. You could not lend $260,000, even though the home is worth $500,000, because of the fact that there is another outstanding loan on there. Is there a way to avoid this taxable benefit that we talked about, which is really the only downside? And there are some very, very specific situations in which you do not need to record a taxable benefit. So in order to not have a taxable benefit, obviously you need to have your proper structuring, your proper documentation, and make sure that you're doing your timely repayments. But in addition to that, it has to meet a couple of other criteria, which if I can get these slides to slide, mean one, it has to be used as a loan for business purposes. It has to also be used as a loan to purchase, or not and, or it has to be used as a loan to purchase company property or to buy company shares, and it must have a reasonable interest rate and proper documentation. So the interest rate is, like I said, prescribed. We have a set amount that's prescribed by CRA. We will take care of that for you, so that's not an issue. Documentation is not an issue, but the other criteria is that it must be used for business purposes, and it can only be used, or it can be used for a loan to purchase company property or used to buy company shares. Now, this is again why that single purpose loan doesn't carry a taxable benefit on the T4 the way that the home loan and auto loan would. Now, getting into what is required documentation in case we're not the ones doing it for you. I swear I'm going to get this keyboard right one day. You need to have a formal loan agreement. It must have the terms of repayment. It must have the interest rate, and it must have the purpose of the loan. And the interest rate, as we said, has to be at least equal to the CRA's prescribed interest rate. Don't know off the top of my head what the prescribed interest rate is right now. It does vary with the inflation, so it does change. So it changes every quarter. It's available on the CRA's or on the Bank of Canada's website. For those of you who need it, I'm sure we can get it as it exists today for you and get the link so that you can find it. But if you're a client of ours, don't worry, we'll take care of that. Again, with the home loan, you've got a unique opportunity that interest rate can be revised every 5 years. So if interest rates are going down as they are now, they can come down accordingly. And I guess that's really everything I wanted to make sure that we covered in this session. I'm sure that there's probably going to be more questions around this. And again, I want to circle back to the director's advances and where people often get confused. Because most people can certainly understand the fact that, hey, if you take money out, it's going to increase the balance in this imaginary account. When you pay for expenses, it's going to decrease this balance. And at the end of the year, we're going to close that out with a salary. Where people often get confused is either looking at the opening balance, because this is like a bank account. It's going to have an opening balance and have a closing balance. So you have to look at what was the closing balance last year, less any director's fees payable that we have listed on the balance sheet. So you might have a director's advance in a debit balance, but you have a corresponding director's fees payable that will offset that. So typically the first journal entry of the year is to clear that debit balance with the director's fees. And then you would have either a plus or a minus in that. So we got lots of questions flooding through. Can you have multiple loans at the same time? Yes, you can. You can have, and the question is, can you have a home, a car, and a boat loan? Yes, you can have multiple. You can have multiple car loans. You can have multiple home loans, as long as they meet the criteria that they are for an employee, and that they obviously are meeting the financing requirements. Is there any way to invest in another business without doing it as a loan? Yeah, absolutely. So your corporation can invest in other businesses, whether that is through the stock market or by just a straight investment. That wouldn't necessarily be a loan out to you. And in fact, I probably wouldn't recommend it be a loan out to you and then you personally invest in that business. I'd recommend doing the investment through your corporation. You said if you take a single purpose loan in 1 year, you cannot do it again in the next year. How long do you have to wait to do it again? Just effectively the third year after that. So in the year you take the loan, in the next year you cannot take a loan and you must clear the balance. In the year after that, you can take another loan. And it's cyclical. So you could basically do a single purpose loan every other year. However, caveat here, you have to watch out for something called a series of loans and repayments. So if you're sitting here going, oh, well, what I can do is I can just take money out of my corporation, at the beginning of the year and repay it at the end of the year, or the end of the second year, and just do a cycle and leverage lines of credits to artificially lower what you would normally otherwise have to take as a salary. The CRA is wise to that. They call that a series of loans and repayment, and they will just come back and deem it all to be income to you. So that's where we say if it's not properly documented, it's not done properly, it could be the entire loan amount could all be deemed as a salary. So it is very important. These loans can be a very effective tool for lowering your overall tax rate, but if not structured properly, can get you into hot water very quickly. Okay. I think that's the last of the questions that we have here. And this was just a short little quick session. We've got more sessions coming up. As always, we are here to help. We offer a free initial consultation if you're not an existing client. And we also do in-house paralegal, which makes it a turnkey solution, allowing us to set up your corporation, do your corporate tax filings as long as you're a corporation, and even go through the dissolution process at the end when you're done with the corporation. We do also offer some proprietary tools like our industry benchmarking to show you how you compare to the average and the median, which helps us to identify areas where you might be at risk because you're above the average, and of course, areas where you might have opportunity for being more aggressive. And to back up those clients who are concerned about being too aggressive, we do offer our audit representation protection, which means we will represent you up until the third and final stages of appeals at no additional cost to you for any of the work that we prepared that you have our audit representation protection for. And last but certainly not least is the benefit of our industry expertise. We've been specializing in this industry since my father founded the firm back in 1984. As I said earlier, we work with the National Association of Computer Consulting Businesses, and that gives us a unique level of expertise around industry issues, such as personal service business risk, which is rearing its ugly head again, WSIB, all the major issues that you might face in the independent contracting world, including things like auto loans, home loans, and those types of fun things that are unique or often unique to this industry. But not exclusionary to this industry. So again, want to thank everyone for taking time out of their schedule to join us today. If there are any questions that you didn't have a chance to post in here, again, come check out our social media channels. We are on all of them, and you can find us. Let me share with you with those handles. There we go. So Facebook at CPA4IT, same with Instagram, X, formerly Twitter. We had to add the underscore. Someone else has got the CPA4IT on us. But on LinkedIn and YouTube, we're also at CPA4IT. Of course, you can scan this QR code to reach out and connect with our website right away. And I encourage you to reach out and ask your questions. Again, we put on this session today because it was one of the things that you guys specifically asked for. Is more input and more insights into the shareholder loans account and being able to take loans out of your corporation. We love to hear feedback from our clients and want to know more about what kind of content we can deliver to you guys so that we can continue to help you organize your finances, create wealth, and transform wealth into a legacy. But if there's no further questions, I'll give everyone back some time in their calendar, and thank you for joining us today. Have a good day.